Hi, this is Dan Beck with Credit Management Specialist. Today we're going to be discussing aggregate revolving utilization. This makes up 30% of your FICO score. It's the second largest piece, so pay attention. Hopefully we can learn something. This piece of your score is the easiest way to quickly improve your score. So my disclaimer for you here is pay attention. You can positively affect your score in a big way in a short amount of time. Now, aggregate revolving utilization sounds very complicated. It's not. Let me explain to you what we're talking about here. All it is the balance to limit on your revolving account. So for example, if we have a Discover card, we have a balance of $500 and we have a limit of $1,000, we're utilizing 50% of our available limits, so our aggregate revolving utilization is 50%. Let's go ahead and add another card into the mix. So now we have same thing, Discover card with a $500 balance. We add American Express card now, and we have a zero balance. So what the score is doing is it's adding the balances on all of our open and active cards together. So we have $500 plus zero gives us $500. Limits now, we have $1,000 on Discover, $1,000 on American Express. So we add those together, we have $2,000. So we have $500 in balances, $2,000 in limits. We're utilizing 25% of our available limits. Now, this is the area where you'll find the most wrong information when it comes to people trying to educate you on the FICO score. Just about every credit repair company that you come across, if you're reading the information that they have posted for any amount of time, you're going to find out that they really are making a lot of the stuff up that they're telling people. What they tell you is that there's three categories or three thresholds or breakpoints to this part of your score. So what they'll tell you is that 70% utilization is the top category, 50% utilization is the next category, and 30% utilization is the best. Unfortunately, that's very misleading information and incorrect information. If you look through here, I'll show you that over 100% is one category, meaning that if I'm over the limit on my credit cards, that's one category. And then it goes in 10% increments from there. So what I'm going to tell you, if you do this at home and compute your aggregate utilization and you come out to be 52% utilization, I'm going to tell you to work hard and get yourself down to 50%. You just dropped the category. And then the next goal you should have would be to drop it down to 40% and continue in that fashion down to 30, down to 20, ultimately down to 0 to 10% of your available limits. Now the problem with credit repair companies, they'll tell you if you're at 52%, work hard to get to 50, and if you get to 50, work hard to get to 30, and once you get to 30, you're great, you're in the best piece of the score. Unfortunately, you just lost a few other categories that you could be continuing to work on and picking up more points. Don't close your credit cards. Here's a big reason why. So let's go back to our analogy that we had before. We have two credit cards. We have $500 in balances. We have $2,000 in available limits, so we're at 25% utilization. Let's say for whatever reason we run out and we close our American Express card. What did that do to us? Well, we just lost $1,000 in available limits. So we've taken our utilization from 25%, we've just increased it to 50%, all because we closed this card. So we just negatively affected our score because our utilization is higher in most situations. So don't close your credit cards. A few other tips: pay off your credit card before the cycle ending date. What I mean by that, and I'll give you an example. Let's say you have one credit card, for sake of ease here, you have one credit card with a $1,000 limit. Let's say you charge that card every month for groceries, gas, whatever it may be, and you average spending about $900 a month on that card. So $900 in balance, $1,000 in limit, we have a 90% utilization. Now, most people get this idea though that if my statement comes in the mail and then I write a check for $900 and I pay that card off in full, that my utilization will always look great on my credit report. Unfortunately, there's one step we're missing if we follow that advice. Check your credit cards right now. Pull your credit card statements out. Get an idea of when your cycle ending date happens, okay? Because what happens, every credit card has a cycle ending date. Let's say it's the 15th of the month. On the 15th, whatever I have charged, so whatever my balance is on that card, that balance is reported to the credit bureaus on that cycle ending date. Then what happens is the creditor reports to the bureau whatever my balance is, and then they mail me my paper statement, give me my 21-day grace period. So long story short, if I pay it off in full when the cycle comes, it's too late. The balance has already been reported to the bureaus. So moving forward, if you're in the process of trying to apply for something, a car, a credit card, whatever it may be, and you know that date's coming up, and this is a practice that you have where you pay it off in full and you get the statement, all I'm going to tell you to do is 3, 4, 5 days before the cycle ending date, just call the credit card company, pay it off in full 3 or 4 days before it ends. Then the cycle ends, your balance is zero. Somebody pulls your report, now you look great on this component of your score. And remember, this is 30% of your score, this component that we're talking about. Another thing out there, line item utilization, another piece of this score. What that means to you is utilizing a fewer number of accounts is actually better than utilizing all of your revolving accounts. So if you have 5 credit cards, don't play the game where you say, okay, I'm going to put $100 on this card and $100 on this card and $100 on this card, etc., etc. You're not helping your score, you're actually hurting your score in most situations because you're utilizing 5 cards at one time rather than only utilizing 1 card. Another one, it's not about your balances. People think that, oh, my balance is so high that my score's got to be bad. Unfortunately, or fortunately, depending upon who you are, that's not the case. It really comes down to a percentage. So you can have somebody with $10,000 in credit card debt today and still have a great credit score. One of the ways they're going to do that is if they have $10,000 in balances. Ultimately, we'd like to have them $100,000 in available limits because they're only utilizing 10% of their available limit, which puts them in the best category, maxes out that piece of their score, going to help improve their score. Okay, and then the last piece on there, it has nothing to do with your income. The FICO score knows nothing whatsoever about your income. People get confused by this because they try to blur the line with this and a mortgage broker. Mortgage people, are always factoring your debt to income ratios, to qualify you for a loan. The FICO score is not doing that. It has nothing to do with your income. It's not talking about that piece. So that's all we have for this part of your score. I hope you enjoyed it. If you have any more questions, you can jump on our website. It says on there, cmsconsultants.net. More information on there, some other stuff you can read and get into if you want to learn more about this piece of your score or any other pieces of your score. Thank you for your time.